Welcome to the New Theory Podcast. I'm going to edit this and post. CPA here, 87,000 subs. The guy is a gamer. I wanted to have him on because he offers courses and he does stuff for people like myself. I know enough to do my own taxes, but I don't know enough to maximize those opportunities. So CPA, why don't you give us a little bit about your background and tell us who you are?
Well, hey, again, thanks for having me on. So I am a certified public accountant. I'm out of Oklahoma, and we still ride horses here to work. So with that being said, you can kind of get a glimpse that we're here to have some fun. But I am registered with the IRS, so in all 50 states. I travel around the country talking to fellow tax pros and small business owners from Seattle to New York to California to all the four corners. And what I love is the opportunity to help your audience, if you will, that just what you indicated. What are some of the things that we can take advantage of? But the big thing as being a CPA is that I don't really want to give anybody ideas or tips that's going to get them in trouble. So we want to come up with strategies that make sense, that are basically easily allowed, but many are just not aware of it.
Well, in the age of the fake guru, the thing I like about your program and programs are you'll have, okay, here's some guidelines, here's what to do, here's some recommendations. You don't tell people what to do. It's for them to filter and learn. But you also offer useful worksheets and spreadsheets, which is at your price level insane because, you know, people generally just like, hey, do this, you pay and you leave. But you actually give the resources to do it. So give us kind of why you got into the self-help for financial.
Yeah, and I appreciate that opportunity to talk about my seminars. And you kind of hit the nail on the head. When somebody comes to one of my seminars, they're able to then go back and rewatch it. They get all the materials that I present, as well as you indicated, any kind of examples or links that go along with it. And the reasoning for that is that as a CPA, my practice is full, meaning I have as many clients as I can handle. There's only so much we can do in any given day. And so I really felt as I was kind of hitting the milestone of approaching 50, and I've been doing this for 30 years, I was like, you know, what's a different way to go about this? And I'm going to be honest with you, I had a YouTube channel for 2 years before the pandemic. I did a video every day. We did a lot of different content, and it just didn't really go anywhere. And I really almost gave up on it. And then when the pandemic hit, I actually was putting together videos, but only for my clients, which I had never done before. So because everything was rolling out so quickly with the PPP and the ERTC and the EIDL and all the things that were changing so quickly, the videos were really for my clients. But I was kind of really first on the scene accidentally, so to speak. A lot of people were tuning in. And about 2 weeks into the pandemic, I went from 2,500 subscribers to 10,000. And so I really kind of had a heart for it. It sounds maybe cheesy, but for all the pandemic, I never charged for my time. I went live, did consults. I just didn't charge. I just felt I was doing a service, and it was alongside helping my clients. And then as we got really at the post end of it, there seemed to be a need for maybe beyond learning about the pandemic assistance. And so with that, that's where I felt the seminars was a great use of my time. And so I felt if I could put together a seminar, it's well beyond what a video is going to provide, let's say for free on YouTube. And so when it being cost effective, I just look at it as I kind of want to make sure it's available, because I think who's tuning in the most to my channel are the small businesses, the self-employed. And I feel like there's a trust factor if somebody's not trying to gig them for $1,000. So most of my seminars are 97, 197 for a package deal. So I feel like being reasonable puts it in a position to be helpful as well.
I like it. So one of the things that attracted, I found you in search, and what happened was I have two LLCs. I'm not I'm W2 in my own firm, but I'm LLC guy, right? Two LLCs, and you know, theoretically would normally be complicated taxes, right? But then I went to a tax place, and they just asked me these like set of questions. And I have a feeling, I'm like, these just seem too standard, right? What did I do? I said, no, I'll do it myself. Went to TurboTax, asked me those same questions, and I've been doing my tax. Since I do have an MBA, so I'm cheating a little bit. I know enough to be dangerous. They have a premium service that if you need, like get an NOL, a net operating loss 1 year, I did have to pay the $100 for that. But you kind of filled that gap of me not needing to do certain things. So number one, thank you for your content. And for small business guys like myself, you're extremely valuable in what you have to offer. So how do you mix it where you're the content creator, right? And we know like YouTube is good money, but like it's tough, right? But then you want to create a product and you made it very affordable. Give me kind of like your push and pulling on your monetization strategy.
Yeah, and I appreciate that. And I'm glad to hear that my videos are helping in real life
Yeah.
situations. I appreciate you sharing that. And you alluded to it earlier. What I really do try to do in the videos on YouTube is not really a full step by step, not really something that somebody could actually then just watch that video and go do it. It's more to give the idea because every situation is so different just based on the set of circumstances for each person, each business. And so I feel like, well, if I can give you the right direction with the link, where to go read about this and all the details that go into it, then I feel like somebody just similar to you can really take it and run, because many just know, hey, there's something out there, but what path do I get on? And so I want my videos to do that, really get them on the right path. And really my strategy has just been trying to be what is my clients needing and what are my clients interested in. So being a CPA and in tax practice, doing it for 30 years, I really only work with small businesses. Most of my businesses are 10 employees or less, $1 million or less gross, and they're closely held, meaning it's 1 to 2 owners. So the issues that they're dealing with, and it seems like that's kind of touched a nerve. And with that, what I love about YouTube is I've now more really for the last couple of years been trying to put together videos that are more maybe what we'd call legacy videos, meaning they would be more helpful than just in the moment.
Evergreen, yeah.
Yeah. And with that, I mean, I know you could look at YouTube and of course, subs is a great indicator. But, really, honestly, since the pandemic, the interest in my channel is not quite the same, in the sense of it's more now, well, when somebody come across that need, they're searching for something that I'm presenting.
Correct.
Whereas during the pandemic, it was almost, well, everybody has this need.
But
And
you build social proof though, meaning I know like it's probably accidental, but you did it well. Like you're a CPA, right? Which typically are the bean counters. But as a marketer, I found genius in what you're doing because you found a platform, you were consistent, the market grew, and then maybe you might not have the same viewership as you did. People find you, and when they see, oh wow, 87,000 subs, you now have a social proof. So I'm actually admiring from the marketing angle. Gator McCluskey is a good friend of the show. He does have a question. He goes, I'd like to ask if those of us making under 400K a year can still expect to be audited by an overfunded, over-aggressive IRA in the next year or two. Cheers. What are your thoughts on that, Jay? Now, a little controversial question. I want to get you in trouble, but feel free to answer as you see fit.
well, really, I don't foresee, even though we know the IRS got more funding out of the Inflation Reduction Act, that's really something that's spread over the next 10 years. A lot of it's going to go to customer service, IT. I think there's going to be a lot more AI, artificial intelligence type of really research by the IRS of where they would need to go and audit certain things. I think there's going to be a lot of enforcement related to payroll tax. I think with cryptocurrency foreign, which means that I don't really see a big uptick in those that are making less than 400,000. And the IRS looking at what you do one year versus what you did the next year has never really been a factor that I've ever seen as a quote unquote audit flag. Because every business is different. Your cash flow is different. Your needs for doing deductions are different. So doing something one year and not doing something the next year, or having a bunch of income one year and not as much the next year, that is not really something that the IRS is interested in, unless you're already doing something illegal and the CIA or the FBI or there's authorities that are reviewing other things you're doing. And so then they might be interested in wanting to know some of the things about your taxes, but that's not really the most, that's not most anybody out there doing that. So I just really feel like we should see the IRS as a referee.
Yeah.
So if we were even to take our kiddos to a sport, baseball or football, none of us would think it was outrageous or be scared or nervous that there's now a referee on the field
Correct.
calling plays. And what it comes down to, like with a touchdown, is the referee is going to either say it's a touchdown or not. So I've never seen that the IRS is out to get anyone. I think that they rightfully at times want to verify, but that's really what it comes down to. It's almost like they want an instant replay. So
Yeah.
if you have the right documentation, really what it comes down to, then you shouldn't really have anything, in my opinion, to worry about. So even if you get questioned, I tell clients, I'm like, well, why would we be worried about that? We're doing it properly, correctly. We have the documentation. So we shouldn't be worried about an instant replay.
You bring a great point, and I want to bounce this off you. I think our father's IRS was different than ours, right? We grew up being scared of the alphabets, especially being an Italian from New Jersey, like IRS, FBI, yeah, the whole bit, right? With that being said, though, is when I started doing my own taxes, I made some major f ups. Forgot a 1099. One of the companies had a different designation, so they missed a W-2. I made some pretty big errors over the years doing my taxes. Every single time, it was very simple. Hey, Tom, you kind of came at this. We're here. There's this difference. Of course, they put a big on it. Just, if you agree, pay us. And if you disagree, fight us. I always pay. I'll tell you a quick funny story. One year, I owed them $2,007. I said, you know what? I'm going to overpay them. I overpaid them by a penny. They sent the check back for 1 cent. So do you agree that like it's really about intent? Like they generally, this is live. David, how are you, sir? We're just kind of engaged in the conversation. Would you agree that like they generally work with you? They generally want to work with you. They're a business too. They don't want to send an auditor out for a guy who makes 150. You know what I mean? Like, give me your thoughts on how the IRS operates. And when you get that letter, I generally just pay, and I never had any issues.
Yeah. So what you're really talking about is a matching letter, as they say in the industry. And anybody that gets an IRS letter, if you look up at the top right, if it starts with a CP, that means that it's computer generated, meaning no human being has actually been involved in the decision of sending that letter. So it's very easy that the computer has misinterpreted something or didn't know how to match something up. And those have become really the way that the IRS has found it more efficient. So more and more of our information, 1099s, W-2s, 1098s, on and on, have to get reported to the IRS. So if we work for somebody or we get paid as a business owner, then there's going to be those forms that person who paid us is going to then send to the IRS. This computer system, if you would, the AI does then a matching of it. So they go, well, here's your return. Here's what was presented to us. Do we find it? And, there's many times that there's multiple places that something can go on your return. The AI is not going to know. So they're going to then just send out a letter, the computer system. The other is there is very genuinely similar to what you just indicated. People go, oh, shoot, I forgot I got into doing that investment and they provided me this, but it was online and I didn't realize that it had a tax consequence. And so then you have to pay it. But most of the time, when you then respond, that's the first time that an actual human being, an actual IRS agent is then looking at that. I always suggest to just write a letter. If you do want to disagree, you check a box, you write a letter. It's always better to write a letter to the IRS for a couple of reasons. One, many want to call the IRS. You're going to get the agent that's first available, depending on their experience level. If you have not done any correspondence, all they're going to know is what the AI letter sent out to you. They're not going to know anything else. They're not going to be able to resolve anything for you. They might be able to give you some additional information. But all to say, when you write a letter, the biggest benefit for that is that you're actually now going to get a human, a IRS agent that will have the expertise in the matter that's being reviewed or challenged by you. So when you send a letter, the IRS looks at it and goes, okay, because that code that's up at the top right, the CP, and then the numbers behind it.
Correct.
So when there's a response to that, then the IRS routes it to the IRS agents that are familiar with that issue. And you're right, just really to get down to it, the IRS goes, okay, give us some explanation. Here's the instant replay. Does it match up? And with that, many go like you're like, ah, shoot, I did miss that. So I'm just going to pay it.
Yeah.
And end of story. And it doesn't yield to an audit the next year. So the other benefit of the letter is that it's then documented, it's registered, you're able to further explain it and provide documentation. And so we usually, anytime we get those letters, unless just the client inadvertently missed something, which is just human nature, we've always prevailed in coming back to say, well, no, this was reported here, or okay, here's the documentation to back that up.
Yeah.
And the IRS very easily then makes the correction and we move on.
Yeah, and I think people should be, I mean, don't get me wrong, not your friends, but they should definitely not be afraid. All right. So I want to get into the ERTC in a moment, but prior to that, maybe an evergreen idea. What are maybe the top 2 or 3 mistakes and or missed opportunities by guys like myself doing my own taxes? If you had oh my God, if I had $1 for every time that I heard this, what are some of those things?
Well, if you're filing a Schedule C, which means you're a sole proprietor, you could be an LLC filing a sole proprietor Schedule C. So Schedule C is if you're getting a 1099 for being a gig worker, or you're doing some temporary work or some night work, or maybe it's everything that you do, but that's where that income gets reported kind of as a starter, that Schedule C that goes with your individual tax return. And on that, many easily miss the home office deduction. The IRS has really given you 7 easy ways to qualify. There's a simplified method. You get up to $5 a square foot, up to 300 square feet in your house or apartment. And the maximum deduction you can get is $1,500. The other is deducting your cell phone, deducting your mileage. And as it relates to then even not giving you a specific, but for many sole proprietors, it's then at the end of the year going back through your bank statements, credit card statements, and just looking for, are there some expenses that I did spend? Because what it comes down to under Code Section 162 is that if your intent of spending that money was for business purposes, you otherwise wouldn't have spent that money.
Correct.
And you have the documentation, which is a receipt, then you can take that deduction. And so there's many expenses that just get missed because they're not taking the time to look at it. And I'll just say also with the Schedule C filer, once somebody starts netting $20,000 to $30,000, they really need to consider, is it time to elect to be an S corporation? Now, they do need to be formalized as a LLC or an Inc. But when you're an S corporation, you then file a separate return, a Form 1120-S. But here's the big thing, the net income, and I'm going to tell you where the rub is in a second, but the net income that's reported on an S Corp return is not subject to tax at the corporate level. It is subject to tax down at the individual level. But really, when you kind of compare apples to apples, the net on a Schedule C is going to be pretty much the same as the net on an S Corp. But here's the big difference. The net on Schedule C is going to be subject to an additional tax called self-employment tax, which is 15.3% up to $147,000 in 2022. Above that, it's 2.9. But that's in addition to your income taxes. So somebody that nets $40,000, well, when you look at that tax, they're going to have $6,000 of self-employment tax on top of their income taxes. Now, with an S Corp, that net income is still getting reported on the individual return, but by law, by statute, it's not subject to that tax. However, you do need to pay yourself a wage, but that's where a little bit of the complexity comes, in the sense that the IRS doesn't have a formula. It needs to be reasonable. So with that being said, when you pay yourself payroll, it being subject to payroll taxes, you're your own employer, 7.65% for Social Security and Medicare taxes gets withheld. There's a match of that same.
You put a cursory amount, like $40,000 a year or something.
Yeah. So really what it comes down to is you're then picking how much of your income is going to be subject to that versus just all of the net income. And so you should come out ahead. I said at the beginning, when you net 20 to 30,000 and you feel you're going to do this long term and you're going to get more, that's when you start considering this, because the cost of having an S Corp, setting it up, accounting fees, payroll fees, annual tax preparation fees, getting QuickBooks, call it $3,000 a year. So if you're netting $20,000 on a Schedule C, that's $3,000 in those expenses. So it wouldn't make sense to set up an S Corp. And so really, when you get to that point, that's the time to consider it. And with that being said, those would really be the biggest things. And then really for those that have self-employment, making sure you're also deducting your health insurance, because that's a deduction even if you don't itemize your deductions on Schedule A.
Beautiful. Okay. Wow. I've always been interested in doing a S corp. Maybe now it's time to revisit. Okay. Now, why I wanted? Well, I wanted you to come on for many reasons, but today's topical reason is this ERTC. Okay. Now, give us a top line because I did cast out a net and I have some questions. But give us top line on the ERTC credit, please.
So the employee retention tax credit is over, but it's not too late to go and get it. So if you paid wages, W-2 wages to employees between March 13th of 2020 through September 30th of 21, you've met the first requirement. Now, if you're a recovery startup business, which means you started your business after February 15th of 2020, and you got less than $1 million in gross, you could qualify for the fourth quarter if you had a governmental shutdown. But let's just really focus in on those businesses that probably aren't a recovery startup business. Correct. So you are an employer, you've paid the wages. So with that, if you have a governmental shutdown that has actually, in fact, affected your business, or your gross receipts are down, if you meet one of those two qualifications, then the time period in which you qualify, then you get to take all of those wages and multiply it by the credit percentage, and then you file a Form 941X and you get a check back from the IRS. So in 2020, if you're down at least 50% in any quarter in 2020 compared to that same quarter in 2019, you qualify for the entire quarter and automatically the next quarter. In 21, you only have to be down 20%, and that's compared again to the same quarters in 2019. They have an alternative method, but we don't want to get too far in the weeds. But here's the big thing. In 2020, it's up to $10,000 in wages per employee. Now, the definition of wages for ERTC includes the employer paid health insurance, but it's up to $10,000 in total per employee. For the entire year, the credit is a 50% credit for the entire year of 2020. So it's really a max credit of $5,000 per employee in 2020. But in 21, it really blew up because this is $10,000 of qualified wages for each quarter in which that business qualifies. And that credit is also 70%. So if somebody has, in this example, max wages, even just with one employee, meaning they've at least paid them 10 grand in quarter one, quarter two, and quarter three, and assuming they qualify for all three quarters, then they would be getting a $7,000 credit times three, 7,000 for each quarter, which would be 21 grand. Add it together, that puts it to a $26,000 possibility. Right? Yeah, it adds up. And then on the governmental order, I do want to really what it comes down to is there are a lot of cold calls going out there, a lot of advertising, a lot of email. You really want to be careful on this because when you're looking at the governmental order, the biggest thing is there a signed order that really did actually affect your business? It's not just enough that you had an order. It was there an effect to your business as in a partial or full shutdown?
That's what I was going to ask.
Yeah, and that's the big thing. And that should be easy. Was there a governmental order or not? And not to get too technical, but if anybody would read IRS notice 2020-21, 2020-21, you Google it, you find it. The IRS really went out of their way to write this IRS notice in a very layman terms. It's very easy to understand. And they have, I think, over 80 examples for us, like Q&A, very realistic. And so anybody that's also curious on that, I'm just going to plug it because you did, and I appreciate it. But I have an employee retention tax credit seminar that someone can go to my website, jjthecpa.com, if you don't mind. And $197, it's a 3-hour seminar plus a 2-hour seminar on how to actually complete the 941X. It's really A to Z, a do-it-yourself. I give you the links. I give you the spreadsheet, the seminar notes. I give you an example of how to calculate it so you can follow along, as well as spreadsheets, Excel spreadsheets. And I've had lots and lots of different levels of understanding of tax, meaning from somebody that didn't know anything about tax to CPAs, EAs, and tax pros say, wow, it really was A to Z. I really could watch this and get it all done and taken care of, and they actually got their money back.
Now, those people watching on the rerun, I put it in the chat, but I'm also going to put it in the description below. And then for those listening on iTunes, you're going to also see that as well. because to be fully transparent, I got the calls like everybody else did. They want 20% of whatever they're going to do for you. It's on contingency. So you're like, it doesn't cost me anything. And what if you have a $10,000 return for 1 quarter? You're going to pay them $2,000 for what you can learn on JJ the CPA for, what is it, 197? Forgive me.
197. And if you don't mind me speaking to that just for a second. So there are good companies out there that are trying to help people. So I don't want to just blast everybody here, but it is a true indicator that somebody is probably not, and I'm just going to be blunt, and I don't want to offend any of your viewers or fans or subscribers, but somebody who's charging a contingency fee actually is doing that improperly. A contingency fee is not allowed by the IRS. It's in Circular 230, Section 10.27. The IRS indicates you can only charge a contingency fee if there's already a challenge or audit going on. There is no challenge or audit when you're filing 941X. Here's how they get around it, though, okay? So for them to do it properly, then you're signing an agreement with them, at least the ones that I've seen, that indicates that they're saying to you, we're not a tax expert, we're not providing tax services, and we're not going to prepare your forms for you. And the reason that they're clarifying that is that they then, if the IRS were to inquire of it, don't fall under Circular 230. So I just say to people, if you're signing an agreement and they actually are having you agree and to sign off on that you've just hired somebody that's not a tax expert, they're not providing tax services, you need to consult with your tax advisor, and they're not doing tax preparation services, why would you pay that kind of fee to them? And so all to say, watch out for yourself. Part of what we've seen is the aggressive groups is that you have a company, let's say in Michigan, real life example, the company in New York is the promoter. They contact that company in Michigan. That company in New York is now just a promoter. They hire a accounting firm in Florida, lawyers in California. And if you decide as a business owner you want to sue because you feel that something was done improperly, well, your agreement that you have to go and sue is in that in the state of now Delaware. So my point in saying all that is just be aware, because somebody who's doing this properly, even if they somehow have come up with a way that they feel in good conscience they can charge a contingency fee, if they're putting in writing all those things and they're dealing with people across the country, that doesn't mean they're big time. What it means is they're reducing down their risk. Let me tell you two other things, if you don't mind.
Please.
On the employee retention tax credit, it is a tax effect, which means that you have to reduce down your deduction for wages. Here's the big rub on it, though, is that if you're filing for the ERTC, let's even say now, you put in your Form 941X, but if that credit is related to wages in 2020, if that credit's related to wages in 21, the IRS dictates in IRS Notice 21-49 that you have to go back and amend your return. They're very clear about it. They don't mix their words. So you have to go back and on your 2020 and 2021 income tax return for your business that can flow to your individual, you now have to reduce down your deduction for wages, which increases your taxable income. And so there will be tax due. So when you get this money, you really should set aside about a third of it, if not 40% of it, that you're going to give right back to the IRS, most likely with penalties and interest. That's why I say 40%. And if you are paying any kind of a fee, contingency fee, that is only going to be deductible in the year that you paid it. Supreme Court's even ruled on this. Not directly this, but on terms of when you get to deduct contingency fees, it's when you pay it. So somebody in your example that's getting $10,000 in employee retention tax credit, they're going to then go back, amend their return. It's going to increase their income by 10 grand. They're going to owe the tax, the penalties. The $2,000 payment that they're paying, if you will, is then deductible in the year in which it was actually paid. So they don't match up.
Not the year where it's kind of jacked up a little bit. But really quick though, you do the 941X, you do all that, but I want to, you finish on, I didn't mean to cut you off because I wanted to share something real quick. Did you finish that thought? I'm sorry.
I did. Yes. Yeah, we're good.
Okay.
Yeah.
So one red flag, and then I want to run through some quick scenarios before you wrap up. One guy that I know and trust was like, hey, you ERTC and this other stuff, and then I found you afterwards. But And he calls me up. He's a mover and shaker, he's an entrepreneur, and he's like, "Oh, we take 20%." But what the super red flag, and I love this guy, I'm not gonna say his name, says to me, "Oh, by the way, if you refer anybody, you can get 1% of their total."
Mm,
It
mm,
doesn't feel right.
mm.
Let me call
Wow.
JB the CPA. That didn't feel right. So I elected to do the first quarter myself, and I'm going to get your course as well to finish up the other quarters. So I do have some quick questions before we run down. These are hypothetical. Do not, even if your situation matches what I say, JJ and I can speak for us. Always seek professional advice. We're just giving top line information. I don't want to get an Instagram and say, "Hey, JJ and Tom screwed up my taxes. This is for entertainment purposes only." But I do want to ask some questions. So I get the reduction portion, that kind of stuff. It makes sense, right? But what if you were a what is that? An essential firm, right? I'm 3 years old. Third quarter of 20, you're an essential firm, and you didn't decrease on revenue, but your operations were partly shut down. I'll give you an example. I own a UPS store. I had to stay open. My revenue was up, but I couldn't buy paper because I was subject to shutdown. Would I qualify hypothetically for ERTC even though my revenue was up and I was essential but partially shut down? Or would I be disqualified based off those parameters?
So when you are qualifying due to a governmental shutdown, it's by a governmental order, not suggestion. A mask mandate is not enough, just as a FYI.
Correct,
And
correct.
it doesn't matter if your revenue's up, just to make that clear. So even though your revenue's up, if you're qualifying for the governmental shutdown, that's okay. And during a governmental shutdown, it is only the exact days of that order in which you then qualify for. You don't qualify for the entire quarter. And with that being said, if there was an effect to your business, even being essential, if you look at IRS Notice 21-20, the
Yeah,
IRS actually spends more time showing how essential businesses can still qualify. So,
interesting.
with that being said, an essential business that had no effect, never closed, open to the public, everybody came to work, well, then there was no effect. But an essential business that also has non essential operations. So, I'm assuming with the UPS store, knowing what they're in, all the services that they provide, most likely there's also non-essential services that
Right.
are being provided. And so if the non-essential services, the revenue
Yeah.
in 2019 is more than 10% of the overall
Shut down.
gross receipts of that business,
It's a
and
lot.
that non-essential portion of the business was then shut down partially or full,
Yeah.
then the entire business qualifies, all the employees, if you're less than 100 employees in 2020, less than 521. And
Wow.
it's actually an IRS notice 21-20. Go to question 11, and the IRS gives a great example of how this is then calculated. So it was the IRS where I got the idea. Now, if all you were not able to get was some supplies, that doesn't sound enough that it was critical. Now, if it was so critical, whether it's your business or not, that you did have to shut down, the IRS gives another example in Q&A number 12, I believe, where you have a business that's an automotive shop and they have a supplier that was under a governmental shutdown. They
Yeah.
had an order with that supplier. This was critical to that business. And because they couldn't get, in this example, basically like the motor,
Yeah.
and then the business had to shut down, then the IRS indicates that that would be enough. But it has to be that there really was an order. They couldn't get it anywhere else. It was critical. And here's the most important part, that the business actually did shut down partially or full. So
Yeah.
those that are getting
Yeah.
talked into, if you had a supplier qualifying you, then they really want to be careful about. And also in IRS Notice 21-20, the IRS has two sections about that. I can't remember the exact Q&A, but they go out of their way. They have a really long paragraph on how you would qualify for that and how you don't. So to me, it really does need to just be examined case by case.
Now, one last example, and hypothetical, of course. I know of another business, essential, money up, um, full supplied, fully ready to go. But just like many businesses that were essential, kept getting COVID infections. So what happened? Team A out, closed down clean, open back up. 2 weeks later, another infection out. So I understand also the cleaning times and shutdown times and those disruptions. And again, subject to your person who does your taxes or yourself. But I understand also that might also come into play, JJ. No?
I don't think that it would actually.
Okay.
And
Okay. Okay.
let me tell you the one way it could in a
Yeah.
second, but I keep harping on IRS notice 21-20,
I'm
but the
gonna
IRS
flip side as well.
addresses this specifically, that if a company is taking their own precautions, even related to COVID, it's not enough to qualify them. Now, here's maybe the one way, and it would have to be a very clear set of circumstances, that if there was a governmental order that indicated that any business that had a certain percentage of employees that had COVID, then they were required to shut down due to governmental order, then they might have a good argument of qualifying, but would only be during the time of that shutdown, number one. Number two, again, it has to be very clear to that governmental order. So voluntarily doing something doesn't qualify. The IRS even goes on to say, even if there is a mandate, that doesn't qualify as an order. Even if it's a suggestion, even if it's something that they feel affected the customer coming in. So we know there were many that said, well, if I got to wear a mask, I'm not going into your store. The IRS has said that's not a governmental order shutting you down. That's a customer that's decided not to do business with you. That's not enough to do it. And the IRS also covers that specifically in that IRS notice 2021. I'm sorry, 2021-20.
20. Yeah, and I pulled it up. I'm going to look at it. I'm going to put a link below JJ's course, as well as that. And so what you're saying is, if you have an essential business, but if it's greater than 10% of your vendors are shut down based off mandate, then you may, again, let's revert back to the notice. But the other thing I wanted to ask you before we conclude is governmental mandates. I'm assuming these are state level mandates, correct?
Yes, and mandate, IRS says, doesn't qualify. It's got to be a governmental order. And if it's okay, because we're talking technical, 10% of your vendors has no effect unless it causes you to shut down. 10% of your business is non-essential operations. So sorry to be technical, but
no, we want that. That's why we want. Got it.
But no, a mandate's not enough. It's got to be a signed governmental order where the business had no choice. Mandate may feel like they had no choice, but again, in that notice, I feel like the IRS really goes out of their way to define what a governmental order is. And if you don't mind, in my course, I more gear it towards, here are all the ways you qualify. I mean, the IRS does go out of their way, believe it or not, to say, here are all the ways you get to qualify. But believe it or not, there just are some ways you just don't qualify.
Yeah.
And so at the same time, in my course, I want to make sure that if people are going to get this, that they're doing it properly. The IRS will only hold the employer responsible for repaying this if they got it in properly. You asked for some flag.
You're on the hook for that, and you got a pretty expensive loan from the government, essentially.
Yeah, with penalties and interest. And so I don't say that to scare, but more what I say is, you hiring a tax expert in anything, the IRS never lets that be an excuse. You can go all the way to tax court, any kind of federal court, circuit court. The government does not allow you to say, well, I relied on this expert, no matter how complicated it is. And even if you go, but I hired an attorney and I have a letter and they're the biggest one in the nation and I had a CPA and I relied on them, the government goes, we don't take that into consideration. You and you alone are solely responsible for this. Now, they may go after promoters such as this for aiding and abetting in helping people break the law is really what it comes down to. And so what I want employers to think about here is that knowing that you're 100% responsible, knowing that you're going to have to pay tax on this, knowing that you're going to have to pay a fee, then get comfortable with what it is that you're being told. And one way to do it is, and I'm only plugging $197 seminar, which I don't think is much, but get educated on it, whether it's by me.
I get educated. Yes.
Yeah. I mean, get educated on it because you're responsible and then you can feel good about it. You know, some of the flags are the self-employed on their self-employed earnings. The IRS is clear in IRS notice 21-20. Again, that they don't qualify on their net earnings. If they have employees they pay W-2s to, they can. The other aspect is if you've not filed a 941 in the past, I don't know how then all of a sudden you can go and get this if you haven't paid W-2 wages. If you paid your workers on a Form 1099, that's not a W-2, they don't qualify. If your credit is more than actually what your wages are for that quarter, which you just look on your original Form 941, it's the quarterly report you send to the IRS that shows here's the wages for the quarter. There's a line 7. It's pretty clear. Anybody that can read is going to see here's my wages for the quarter. If you have a credit that's larger than that, well, then that should be something to either question or recalculate, so to speak. And so at the end of the day, I feel as though the IRS, unfortunately, isn't going to be able to review all of these, but this is not a headline. I don't have any way to verify it, but there are a couple of articles a few months ago where some managers at the IRS were just being interviewed and providing friendly information, so to speak. And they had indicated that as they understood it, the IRS has moved 90% of its auditors over to the ERTC issue. The U.S. Treasury did a sample audit or kind of a review. And with just over 11,000 Form 941Xs, they came up with 2 trillion with the T, 2 trillion in fraud. So with this being said, the IRS really rightfully so will be inquiring of this. But what did I say earlier? So what? They inquire. If you qualify, you qualify. There's no reason to go, well, I don't want to do it if they're going to come and look at it.
Yeah.
Why would we be worried about that?
I hate to say, not that it's honor system. It's not that, but a whole bunch of stuff's going to come in. They're going to audit X amount, and then they need to audit or look into, or AI needs to figure it out. And like I said, like obviously, to me, I could sleep at night. I'm about intent, right?
Yeah.
So I will take your course. If I think I qualify, I in good faith say, hey, based off this parameter, on my own decision, I think I qualify. I will submit it. And then worst case, I'm a big boy. Oh, we're on the opposite end of agreement. Great. You know what? I'm a big boy. I pay my penalty and I take my ball and go home, or I appreciate, or I fight it. Right. But either way, JJ, this has been an honor and pleasure. Please keep in touch.
Well, I appreciate that.
You got a big fan over here at New Theory, and please subscribe to JJ's channel. Below, you're going to find the JJ CPA link to the course. I'm also going to put a link to the IRS notice for your affirmation. JJ, give a quick plug before those listening on audio and before we wrap it up.
Well, I appreciate that. You want me to plug myself?
Please.
Oh, well, you're very kind. I appreciate that. Well, here's the bottom line. What I love is that you're bringing value in a big spectrum to your listeners, to your followers, to your subs, to your friends, your family, all those that are tuning in. So it's an honor to be here. And so really what I would more plug here is that by tuning into you, I've had the opportunity now to reach out. You trusting me, I think says a lot. And me being a certified public accountant, knowing that that key word in the middle of my designation is called public. So certified public accountant, which means that when I'm putting out information, I can only put out information that I believe to be true and correct, that's not faulty or to get you in trouble. So with that, what I appreciate, as you have said several times, I'm a trustworthy source, which is to say, I think if you're tuning into my YouTube channel or taking my seminars, it's something that you could trust.
I love it. That's why you're here. JJ, thank you so much for being on the New Theory podcast.
Well, thank you. It's been an honor.